There are a ton of different option strategies out there that can help you make income through the stock market, whether you're starting out with just $100, if you're a millionaire, or if you're just an average Joe Schmo like me with a few grand to spare. Welcome back to Everything Options. My name is Greg, and today I'm going to be giving you the best option strategies in order to make income through the stock market. So to break this video down for you, we're going to cover the more expensive strategies first and work our way down in order to help everybody out and help us all make a little bit more money. And for each strategy, I'm going to give you the basics, I'm going to give you an actual example, and of course, as always, we're going to talk about the risks because you can always lose money in the stock market. That's important to know. But before we get into it, if you learned anything out of this video, or if you just enjoy it, make sure to show some love, leave a like, and let's get into it. Now, the first strategy we're going to cover is going to be the wheel. And the wheel strategy is going to be for our high rollers, the people with a little bit more money to use in order to make some income. And the wheel strategy is made up in two parts. The first part is going to be the cash secure put, and then the second part is going to be a cover call. We're going to cover the cash secure put first since this is where you'll get started with a wheel. Just like the name suggests, with a cash secure put, you're going to need cash in order to put on your trade. This is also going to be called collateral, and the amount of collateral that you need in order to open a cash secure put is going to be equal to the strike price that you choose multiplied by 100, since you're agreeing to buy 100 shares of your stock at your strike price. So some stocks are going to cost a lot more than others. If I wanted to run this on something like AMD, that's going to cost me north of $12,000. Whereas if I did this on a $10 stock, that would only cost me $1,000 in order to run the strategy on that. But you want to choose a stock that you actually want to buy 100 shares of, because ultimately we could get assigned on our cash secure put to have to buy 100 shares of our stock. And I don't just go around buying 100 shares of the stock that I don't really care for. I study these companies deep before I end up buying 100 shares. I'm not just going to spend racks on a company that I know nothing about. And this is starting to sound a little bit more like dating advice, but ultimately you want to choose a stock that you're actually comfortable owning 100 shares of. Now, once you've chosen the one, your stock, you're going to have to choose an expiration date. And the way you go about choosing your expiration date is going to be up to you. Some people like to trade weekly options and sell weekly cash secure puts. Other people like to sell the monthlies. I'm the camp that likes to sell the monthlies. And the reason behind this is because the most amount of time decay, or the amount of theta decay, happens in the last 30 to about 45 days until the expiration. So the last 30 to 45 days of an option's life cycle is when these options lose the most amount of time value versus the last week. Yes, they are going to lose a lot of time value, but in that last 30 to 45 days, that's really the sweet spot where time decay really ramps up. So for me, I like to use monthly call options with 30 to 45 days until expiration. You can use weeklies, I just prefer not to. These monthly options are also going to pay a lot more in premium since they have more time value added to them. So ultimately, you're going to end up getting more bang for your buck, not having to run the strategy as often, and you still get to collect that sweet, sweet premium. So now that we've got our stock and our expiration date chosen, it all boils down to our strike price. And the way that you're going to choose this is by looking at delta values. Now, delta is a representation or an estimate of how likely your option is to get assigned to you, how likely your option is to expire in the money. And when you choose your strike price, you want to choose an option that has a decently low chance of getting assigned to you. So generally, the rule of thumb when it comes to a cash secure put is going to be a negative 30 delta. This means that your option only has about a 30% chance of expiring in the money, to where you would get assigned to have to buy 100 shares of your stock at your strike price. But you also need to make sure that this is a strike price that you actually want to buy 100 shares of. If this 30 delta is a little bit too expensive for you, then you might want to lower your strike price down, or maybe wait for the stock to fall and then sell your cash secure put. But this 30 delta is going to give you a decent chance of this option expiring out of the money, to where you don't have to buy 100 shares, since you have a 70% chance of it expiring out of the money, to where you wouldn't have to buy those 100 shares. You can also go with lower delta, so maybe a 20 delta if you want an even less chance, but the lower that your delta value is and the lower your strike price for cash secure put, the less premium that you're going to receive as a credit whenever you open these trades. So the 30 delta is going to be the best bang for your buck, just like the 30 to 45 days until expiration. So rule of thumb here, 30 delta, 30 to 45 days until your expiration. And the last thing to talk about is the premium, or the amount of credit that you're going to get whenever you sell these options. So this is going to vary from stock to stock depending on how expensive the stock is, how far the strike price is away from the stock price, and a lot of other factors. But whenever you sell this, you're going to get a credit, and you get to keep that credit so long as you don't buy the option back. If you buy the option back, you're giving up your credit, or at least part of it, depending on what premium that you buy your option back for whenever you close it. Since you sold to open it, you're going to buy to close it. And if you buy to close it for a higher price than you originally got credit for, then you're going to take a loss. If you buy it back for cheaper, then you will take a profit. And ultimately, you don't have to close these, but you can before the expiration date. So something to note here. And that pretty much wraps up the basics for the cash secure put. So let's get into an actual example for you. All right, so with a cash secure put, we need to choose a stock that we want to own 100 shares of. For me, I just recently bought 100 shares of AMD, so I think this would be a pretty good candidate for our example today. And we're going to set our expiration 30 days out. Today is January 24th. So we're going to go with a February 25th expiration, which is a little bit more than 30 days, but it'll still be in our 30 to 45 day range. And we're going to make sure we have sell put options selected on the top. And then we're going to sell a $100 put, since this has a negative 28 delta and it's closer than the negative 35 delta with the 105 put. So we're going to sell the 100 put, agreeing to buy 100 shares of AMD at $100 if it's below that strike price on our expiration date out on February 25th. And for this trade, we're going to get paid $525 of credit in order to open it, which means that our break even for this trade is $94.75. So this means even if AMD comes down below our $100 strike price, we would still be at a profit for buying these 100 shares and getting this $525 of credit, so long as it's above $94.75. Again, our break-even price. But if it comes below that break-even price at $94.75, then our shares would start taking a loss, which brings us to the risks of the cash secure put. Now, the bad part about a cash secure put is you're buying 100 shares of a stock. And if that stock keeps going down from where you bought it at your strike price, then you're going to take on more and more of a loss. For example, I sold a cash secure put on MAPS a long time ago when it was trading at like $15. Now it's trading at $5. So obviously not a great situation for me to be in, to have lost about $1,000 on these 100 shares. So that's the risk whenever it comes to a cash secure put, and why you want to choose a stock that you actually are comfortable holding 100 shares of. So for me, I don't care if MAPS is at $2. I think eventually, someday, hopefully, it's going to recover long past my $15 strike price, and I'll be at a profit eventually. But I'm comfortable owning those 100 shares of MAPS for the long term. And this is exactly what you need to be aware of whenever you're selling a cash secure put. Otherwise, if you sell the shares for a lower price than you originally bought them for, obviously, you'll take a loss. Hopefully, the stock ends up recovering, and then you can use the second half of the strategy, which is going to be the covered call. And it's basically the opposite to the cash secure put. Instead of putting up enough money to buy 100 shares, you're going to put up your 100 shares as collateral instead. So this means that you're going to need to own 100 shares of a stock in order to start using this strategy. And for some stocks, this can be a lot more expensive than others. For example, Apple might cost you, $16,000, whereas a $10 stock would only cost you $1,000. So you can start with as little as $1,000, but if you want more established stocks, you might need along the lines of $10,000 or more. But once we have our 100 shares, we can start selling cover calls, and the way this works is just like the cash secure put. We're going to start out with our expiration date, and we want to choose an expiration that's about 30 to 45 days out in order to capitalize on theta decay. Again, the most amount of theta decay happens in the last 30 to 45 days of an option's life cycle, so we really want to capitalize on this by using these expiration dates. Now, once we've chosen our expiration date, then it's time to move on to our strike price, which again, we're going to be using delta values in order to find. Now, with a cash secure put, we had negative delta values because puts will always have a negative delta value assigned to them, but a call option will always have a positive delta. So we're going to be looking for a positive 30 delta. So the opposite to the cash secure put was a negative 30 delta. So with the cover call, we're looking for a positive 30 delta. So this means that this option has about a 30% chance of expiring in the money to getting assigned to sell 100 shares of our stock. And for every dollar that our stock moves, our option is going to change by $30. Since 30 delta is relatively low, this means that we have a relatively small chance of getting assigned to have to sell our 100 shares, which is ideal. We don't want to sell our 100 shares, but if we have to, we want to make sure that we're receiving a decent amount of premium. And the 30 delta is going to offer the best bang for your buck in terms of the amount of premium that you're going to receive and the chance that your option has at getting assigned at the end of it. So again, 30 delta, 30 to 45 days until our expiration. And just like the cash secure put, we can close this any day before the expiration. If we buy this call option back for cheaper than we originally sold it, then we'll be at a profit. If we buy it back for more, then we're going to be at a loss. And if we don't end up buying it back, we get to keep the full amount of credit no matter where the stock ends up on our expiration date. So it could be above our strike price, below our strike price. It doesn't matter. We get to keep that credit no matter what, as long as we don't buy it back. So that wraps up our basics for the cover call, buying it back if we want to. We covered our expiration, and then we covered the delta and our strike price. So let's get into our real example. With a cover call, again, we need to choose a stock that we own 100 shares of. And I own 100 shares of AMD, so I'm going to use this as our candidate for example again. We're going to set our expiration date to the same that we had before, a little bit more than 30 days out with February 25th expiration. And then we're going to find a call option with around a 30 delta. This 128 call has a 0.2985 delta, so that's going to be close enough for us. We're going to sell this call option in order to open it, and right now it's going for $408. So we'll get $408 of credit for opening this trade, which means that our break even would be $132.05. So this means even if AMD is above our $128 strike price on our expiration on February 25th, as long as it's below $132.10, we could buy the shares back for cheaper than we sold it for the $128 strike price plus the $410 of credit. But if it goes above $132.10, then we would be paying more in order to buy back our shares, and at that point we would start taking a loss since we're buying the shares back at a higher price, which brings us into the risks for the cover call. The risks of a cover call are a lot like a cash secure put, but instead of being tied to, owning 100 shares of a stock, you would be giving your shares up short for what they could potentially reach someday. So, for example, if we sold a cover call and we had a $100 strike price, but then our stock goes up by 50%, we're losing out on $5,000 of unrealized gains by selling it at $100 when we could have sold it later for $150. Nobody wants to miss out on profits, so that really sucks. But hey, shit happens. And that's pretty much it with the risks for a cover call. It's a very simple strategy, so it comes along with very simple risks. So let's get into our next strategy. It's a little bit more complicated. Now, there's an options cheat code out there that allows you to sell cover calls without owning 100 shares of a stock. And this is going to be called the poor man's cover call. The way this works is you're going to start out by buying a LEAPS call option. And what a LEAPS is, basically, it stands for long-term equity anticipation securities. So you're going to buy a call option with at least a year until the expiration date. And then once you've bought this, you have the right to buy 100 shares of your stock at the strike price that you chose. And since you have this right to buy 100 shares, you can sell cover calls against it. Now, the expiration date for your cover calls is just going to be like a regular cover call with 30 to 45 days until the expiration. So this means over the course of a LEAPS options life cycle, you can sell between 8 and 12 cover calls in order to cover the cost basis for your LEAP. So each time that you sell another call, you're going to bring down the cost basis that you paid for your LEAPS option. But you want to make sure that the strike price is high enough to where if you end up getting assigned your cover call, you'll make a profit. So we want the difference between our strike prices for our cover calls to be wider than the debit that we ended up paying in order to buy our LEAPS option. So if we ended up paying $1,000 for a LEAPS call, we want the difference between our strike price to be wider than $10. Otherwise, we would take a loss in this trade. Now, with the regular cover call, the way that we chose our strike price was by going with a 30 delta. The way that we're going to choose our strike price with the poor man's cover call is going to be based on, one, the difference between your strike prices like we talked about, and two, we want to have a lower delta call option so we have an even less chance of being assigned on the cover call. So with the poor man's cover call, instead of going with a 30 delta call option, we're going to sell a 20 delta call option, which means we only have about a 20% chance of getting assigned on our cover call. Again, we want to make sure that the difference between our strike prices is more than the debit that we paid for our leaps option to ensure that we make a profit too. So that covers our strike prices, our expiration dates, and now let's get into our example for the poor man's cover call. Now with the poor man's cover call, instead of choosing a stock that we want to own 100 shares of, we want to choose a stock that we want to buy a leaps option for. They're kind of similar, but not really. So with a leaps option, you want the stock to move a little bit quicker than with the cover call. Since you own 100 shares, those 100 shares aren't going to expire. But with the leaps option, that option is going to expire at some point. So we want to keep the trade to something a little bit more short-term in nature. So I think that Fulgent is going to have a really good earnings report coming up over the next couple weeks. So I'm going to be using Fulgent stock for our poor man's cover call example. So we're going to go to the January 2023 expiration, which is almost a year out at this point. So this is going to be the leaps option that we're going to buy. And this $50 call has a 72 delta. So we want to choose a call with around a 70 delta. So this is going to put us close enough to that mark. So we're going to make sure to buy this call option in order to open it for $2,125, and then we're going to sell a call option against it with a March 18th expiration. And I know that the March 18th expiration isn't in our 30 to 45 day period, but the February 18th expiration is like 21 days out at this point. So that's too short for me. So I'm going to make sure to select sell a call option on the top, and then I'm going to find a call option with around a 30 delta. This $75 call has a 31.33 delta, which is going to be close enough for us. So we're going to sell this call option in order to open it. And this is going to bring down the cost basis for the $50 call that we're buying by $370, which means in total, between these two options, we're going to pay $1,750, which is good because the difference between our two strike prices is $25. This means if Fulgent was above $75 on our expiration date on March 18th, we would still be at a profit if we got assigned on that to sell the 100 shares at $75. Since we would be buying the shares at the $50 strike price by exercising our leaps option and then selling the 100 shares at the $75 strike price by being assigned on our $75 call, that would net us $2,500, and the cost for this is $1,750, so we would still be at a $750 profit if this was the case for us. Now, there are some more risks to consider whenever it comes to the poor man's cover call. And the biggest risk, I would say, is your leaps option losing value if the stock continues to go down. So right now, we're experiencing a pretty harsh bear market where Fulgent has dropped from a price of like $85 to $55 over the last few weeks. So if you had bought a leaps option a couple weeks ago, right now you'd be sitting pretty deep in the red. And this means that you're going to have to lower the strike price for your poor man's cover call. So if Fulgent were to keep coming down more and more, then we're going to have to lower the strike price for a poor man's cover call. And at some point, probably the strike price for that cover call is going to be less than the debit that we paid in order to open our leaps option. And at that point, if we were to get assigned on that new cover call at the lower strike price, then we would actually end up taking a loss for this trade. And if the stock just keeps going down from where it's at right now at $55 or so, and it breaks past $50 and stays below that by next year, I think this is incredibly unlikely, but if it were to happen, we would lose the full amount of debit that we paid in order to open these options. So we have $1,750 of risk on the line, and if Fulgent is below $50 on our expiration date out in January 2023, our leaps option is going to expire completely worthless. So every bit that we paid for that option will go to zero if this option expires out of the money, and if Fulgent is below $50 on our expiration date out in January 2023. So some big risks that are associated with a poor man's cover call, but if you choose the right stock and that stock goes up over the next year, then you should be at a pretty substantial profit, and you can continue to sell cover calls against your leaps in order to pay off the price for your leaps option. So that's the poor man's cover call for you. So let's get into our next strategy. Now, the next strategy, there are two types of credit spreads. You have put credit spreads and you have call credit spreads. We're going to talk about put credit spreads first. And it works a lot like a cash secure put, but instead of needing enough money to buy 100 shares of a stock, all you need is the difference between your strike prices that you're buying and that you're selling. You're going to multiply that by 100, and that's the max amount of collateral that you're going to need in order to put on these trades. So you might end up just paying $100 of collateral instead of tens of thousands of dollars, depending on what stock you're trading. And this is the whole purpose of buying one option and selling another option in order to bring down the collateral that you need in order to put on these trades. This is more of a small account strategy, and it can still work just as effective as the cash secure put. And just like the cash secure put, we're going to use the same expiration date as we did before with 30 to 45 days until our expiration in order to capitalize on theta decay because, of course, the most amount of theta decay happens in the last 30 to 45 days of an option's lifetime. But the delta value for the option that we're going to sell is going to be a little bit different because we were okay with being assigned on the cash secure put. We were okay with buying 100 shares of a stock. But with the put credit spread, we don't want that to happen. We don't have enough money in order to buy the 100 shares of a stock. And if both of your options end up in the money or both of your strike prices are above the share price on your expiration date, then you'll take your maximum loss. Luckily, your maximum loss is capped by the amount of collateral that you're putting down, which is going to be equal to the difference between your strike prices, multiply that by 100, and then subtract the credit, and that is going to be your maximum loss for a put credit spread. So you're going to cap your max loss versus the cash secure put. The stock might end up going to zero, and you would lose all of that value. So in this way, you might actually see this as an advantage. But anyway, getting into the delta value for the option that we're going to sell, we're going to start out by selling an option, a put option, since it's a put credit spread, and we're going to find an option with a 20 delta instead of a 30 delta. So this means that this option only has a 20% chance of expiring in the money to get assigned on that, which is significantly lower than 30. So this puts the odds further in our favor to make our maximum profit, which is just going to be the credit that we receive whenever we open these credit spreads. So we're going to sell a put option with a negative 20 delta and then buy a put option with a lower strike price below that. So the option that has the higher strike price is going to be worth more, which means that we're going to end up getting a credit, just like the name suggests, with a put credit spread. So that's strike prices, expiration dates, premium credit. We talked about everything. So let's get into our example. All right, with the put credit spread, we want to choose a stock that we think will go up in the short term. Since our expiration date is 30 to 45 days out, we want to choose a stock that we think will go up in that time frame. I think a good candidate for that right now might be Tesla. They have their earnings coming up, which is going to be later this week, I think on Wednesday or Thursday. So I'm going to use the put credit spread on Tesla and set my expiration date again to February 25th. So we're going to start out by selling a put option and trying to find a put option with around a 20 delta. So we don't want it to be a 30 delta because that's a little bit too close. But if we go with a 20 delta, that means we only have about a 20% chance of our options expiring in the money. So I'm going to search for 20 delta. The 740 put right here has a negative 20.45 delta, so that's going to be close enough for our liking. So we're going to sell this put option in order to open this trade, and then we're going to buy back a put option at a lower strike price. Since that one is cheaper, we're going to end up getting paid a credit, and the amount of credit that we're going to get for putting on this particular trade is going to be $240. Now, the difference between our two strike prices, $740 and $730, is $10. So we're putting up $1,000 of collateral in order to open this trade, but we're getting $240 of credit, which means only $757 is coming out of our own pocket in order to open this trade. Now, if Tesla ends up coming down after the earnings report and selling off before February 25th, then we'll be at our maximum loss, which is going to be the amount of money that we put down for this trade, which again was $755. Now, our break even, though, is going to be at $737.55. And the way that this is calculated is by taking the $740 strike price and subtracting the amount of credit, the $240 of credit, for a break even again of $737.60. But if we're right on this trade and Tesla is above our $740 strike price on our expiration date out on next month, then we get to keep the full $233 of credit for opening this trade. And 23% credit to collateral is pretty dang sweet, especially considering the strike prices being so low on Tesla stock going into probably what is probably going to be a record earnings. I'm more neutral on Tesla ahead of earnings more than anything. Not really bullish on it, not very bearish on it. I think it's probably just going to trade flat over the next month or so. So that's the put credit spread for you. Call credit spreads work very similar to cover calls, but instead of needing 100 shares of a stock, all you're going to need to do is sell one option at the strike price that you think your stock is going to be below, and then buy back a call option with a higher strike price. And you're assuming that the stock will be below both of your strike prices in order to realize your maximum profit, which is just going to be the credit that you receive whenever you open your trade. And then if the stock is above your strike prices for a call credit spread, you'll take on your maximum loss, which is equal to the collateral you're putting down, which is the difference between your strike prices multiplied by 100. And in order to come up with your max loss, you're going to subtract your credit that you receive. So for example, if I get $20 of credit for a $1 spread, in this example, my maximum loss is going to be $80 for this trade. And the expiration date works just like the cash secure put, the cover call, and the put credit spread, to where we want to maximize on theta decay, which is going to be 30 to 45 days, because again, that's when your option loses the most amount of time value. So you want to maximize the amount of money that you can make from time decay. You want to go with 30 to 45 days until the expiration. And the strike price that you're going to end up choosing is going to be based on delta value. So instead of going with a 30 delta value like we did with the covered call, to where we were okay with selling 100 shares of our stock at our strike price, we don't want to sell 100 shares of our stock at our strike price with the call credit spread because we don't own 100 shares of our stock. So we want to choose a lower delta value to ensure that we don't have to sell 100 shares of our stock, and to where we don't have to take our maximum loss. So with a call credit spread, we want to choose a delta value of around 20, which gives us about a 20% chance of our short option expiring in the money, to where we would get assigned to sell 100 shares of our stock. And then we're going to buy back a call option at a higher strike price above that. Since the call option that we're buying costs less than the option that we're going to sell at the lower strike price, we're going to end up getting a credit for this trade, just like the name suggests, with a call credit spread. And if you end up paying a debit instead of getting a credit whenever you open a call credit spread, you actually opened a call debit spread, which has the exact opposite assumption. So make sure that you're getting a credit and not paying a debit whenever you're trying to open a call credit spread or a put credit spread. So we covered our strike prices, our expiration date. So let's get into the amount of credit that we're going to get. Now, the credit that we receive whenever we're opening these trades is going to depend on the stock and how far the strike price is from your stock price, and also how volatile the stock is. The more volatile a stock is, the more credit that you're going to get whenever you open these credit spreads, because it's more likely that the option will end up in the money with a more volatile stock than one that is less volatile. So a stock like Tesla is going to pay you a lot more in premium for a credit spread than a boring stock like AT&T. Nothing against AT&T, it's just not as volatile as Tesla is. And if you can use credit spreads to sell into the direction of volatility, you're going to end up getting paid more in order to put on your trades, and you're also going to put the odds further in your favor. So if I'm using call credit spreads, I'm going to wait for the stock to go up a lot and then sell a call credit spread to put the odds in my favor if the stock ends up correcting down and experiencing mean reversion, because ultimately stocks are based on numbers, and numbers like to go back to their averages. So if a stock is trading high, use a call credit spread and it'll probably come back down to its average. Not always, but this just puts the odds further in your favor. So sell put credit spreads whenever a stock is going down, sell call credit spreads whenever a stock is going to go up, and this is going to increase the odds of you taking your maximum profit for credit spreads. So that covers all the basics for the call credit spread and the put credit spread. So let's get into an actual example for a call credit spread. With a call credit spread, we want to choose a stock that we think will go down in the near term. And I think that a good stock to run the strategy on right now would be Chevron. So their stock price has been going absolutely parabolic over the past couple of months, whereas the rest of the market is kind of down in the dumps right now. Chevron also has their earnings report coming up, and I think that earnings is going to be a major shift for a lot of different stocks. So I'm going to be betting against Chevron with a February 25th expiration date, so 30 days out. And we're going to start by choosing a call option with a 20 delta. This 134 call right here has a 20.65 delta, so that's going to be close enough for us. So we're going to sell the 134 call in order to open it, and then buy back the $135 call above that. And for this, we're going to get paid $21 of credit, And our collateral for this trade, since the difference between our strike prices is $1, 135 minus 134 equals 1, multiply that by the 100 shares that we're controlling with each of these options. You only put up $100 of collateral, you get $21 of credit. So this means only $79 is coming out of our own pocket. And if we're right on this trade, we get to keep the $21 of credit as long as CVX is below $134 on our expiration date. And our break-even price is going to be $134.21, which is the $134 strike price plus the $21 of credit. And then our maximum loss, if we're wrong on this trade and CVX is above $135 on our expiration date, is going to be $79. So if CVX were to keep going up past our $135 strike price after the earnings, maybe they have a really good earnings report, then we could lose $79 if we're wrong on this trade. But there's much bigger risk associated with the credit spread that you need to know about. So let's talk about those. Credit spreads may seem pretty friendly on the surface since they cost you less money than a cash secure put or a covered call, but don't let this fool you because there are two major risks that you need to be aware of whenever you're trading credit spreads. And the first one is going to be assignment risk, early assignment risk. This happens when your option becomes so deep in the money to where your option has little to no extrinsic value and the buyer for your option can exercise the option early to buy or sell 100 shares of the stock at the strike price that they chose. And if they exercise that option, that means you as a seller for that option are going to get assigned for that option to have to buy or sell 100 shares to the buyer. Now with credit spreads, usually we don't have enough money to buy or sell 100 shares of our stock. So in order to mitigate this risk, all you have to do is pull out the reverse Uno card and exercise the option that you bought against the option that's getting assigned to you. So if you end up opening a call credit spread and you end up getting assigned on the call option that you sold, you're going to exercise the option that you bought in order to balance out the trade. Since you're buying the 100 shares with the call option you bought by exercising it and then selling the 100 shares at the strike price that you sold. But the problem with this is that you will end up taking your maximum loss on this trade. You'll end up taking it early since this is ultimately early assignment. But the second risk, there is no remedy for. I'm sorry, if this happens to you, then your account is going to be in a deficit. And the way this works is you hold the option into your expiration date and the stock is between your two strike prices. So if you think that the stock could end up between your two strike prices on your expiration date, then try to avoid this by closing it before the expiration. But if the stock ends up landing between your strike prices, one of your options is going to be in the money, the other one is going to be out of the money, and the one that's in the money will get assigned to you to where you have to buy or sell 100 shares of the stock. And since you can't exercise the option that you bought, since it's out of the money, it has no value to where you can't exercise it, you will have to buy or sell 100 shares of your stock. There's no exercise in the long option in this case like there was for early assignment. So again, if we want to avoid this risk, we have to close our options before they expire with a credit spread. And the best thing is you can close these options any day before the expiration. It can be the same day of expiration as long as you do it before 3:59 p.m. before the markets close. You're off the line to where you don't have to buy or sell 100 shares of your stock. And that pretty much wraps up the risks behind credit spreads. They are super dangerous if they're not taken care of. So always be on the lookout for your expiration date and make sure to close them before the expiration if you think the stock could end up between your strike prices. Now, the Iron Condor is like a hybrid of a call credit spread and a put credit spread. It's basically the combination of both of these together. So our assumption with the put credit spread is we think that the stock is going to be above our strike prices. And again, with the call credit spread, we're assuming the stock will be below our strike prices. So if we combine these two, we're going to assume that the stock will be somewhere in the middle. So between our call credit spread and our put credit spread. And the best part about an Iron Condor, since you're using basically two credit spreads, is you're going to get double the amount of credit that you would receive from otherwise selling a call credit spread or a put credit spread. But you have to assume that the stock is going to trade just about flat. It's a lot more likely that a stock is going to go up or down than it is to trade completely flat. So you're going to end up getting more credit for taking on that assumption, but you are also taking on more risk accordingly. The expiration date is going to work just the same as a call credit spread and a put credit spread. You want to go with 30 to 45 days until expiration. And then our delta value for the options that we're selling is going to be right around the same at a 20 delta for the call options and then a negative 20 delta for our put options. So we're going to sell a call option with a 20 delta, buy a call option with a higher strike price, and then sell a put option with a negative 20 delta, and then buy a put option with a lower strike price. So all in all, we're going to get about double the amount of credit that we would receive from selling either a put credit spread or a call credit spread, but you want the stock to trade between your strike prices of the call credit spread and the put credit spread. If it breaks above or below your strike prices, then you'll end up taking your maximum loss, which is going to be equal to the difference between your strike prices that you chose minus the amount of credit that you received. So if I had a $1 difference between my strike prices for my calls and my puts, and I got $30 of credit for opening a credit spread, then I would have a maximum loss of $70 for this trade. And I know this is a bit more of an advanced strategy, so hopefully this example will help. Now with the Iron Condor, we need to choose a stock that we're actually neutral on. And I was talking about earlier how Tesla will probably trade flat on the earnings report, so we're going to use Tesla in our example again for the Iron Condor. So I'm going to go with a February 25th expiration date and try to find a call option with a 20 delta. This 1150 call has a 19.85 delta, so that's going to be close enough for us. We're going to sell the $1150 call and then actually buy back the $1160 call above that. Now we're going to go to the put option chain, and then we want to find a negative 20 delta. So I think it was a $740 put had a negative 20 delta or close to it with negative 19.25. So close enough for us. So we're going to sell the $740 put and then buy back the $730 put below that. So all in all, for opening this trade, we're going to get $388 of credit. And our break-even prices are going to be $736.47 and then $1,153.50. So if it's below $736.40, we'll start to take a loss. And if it's above $1,154 now, we'll take a loss on that as well. But if it's between our strike prices of $740 and $1,150, then we get to keep the full $358 of credit that we got for opening this trade. But on the flip side, if it's either above $1,160 or below $730, then we're going to take on our maximum loss, which for this trade is going to be $660, or the $1,000 of collateral we're putting down for this trade, minus the $360 of credit that we're going to receive. So the ideal situation is Tesla is somewhere between $740 and $1,150 on our expiration. Worst case scenario, Tesla is either below $730 or above $1,160. And if it's between our strike prices for our calls or put options, that's when we can run into some trouble, which brings us into the risks. Now, the risks associated with the Iron Condor are just like credit spreads. We don't want the stock to end up between the strike prices of our call options or between the strike prices of our put options, because then one of our options is going to expire in the money, one of them is going to expire out of the money, and we're going to either have to buy or sell 100 shares of our stock, which we can't afford to do. So if you assume that the stock is going to be between the strike prices of your call options or your put options, then you'll want to close it before it expires in order to avoid this risk altogether. And then you also have the risk of early assignment, but we talked about that earlier and how it's easy to fix. So if you end up getting assigned on either your call or your put options, all you have to do is exercise the option that you bought. So if you get assigned on a call option, you're going to exercise the call option you bought. Or if you get assigned on a put option, you're going to exercise the put option that you bought. So easy to avoid, easy to fix, and that wraps up the risks for the Iron Condor. So let's get into our next strategy. The Iron Butterfly is like the Iron Condor, but on steroids. Honestly, they should have called the Iron Condor the Iron Caterpillar, but I don't get to choose the names here. And the way that Iron Butterfly works is you're going to sell both a call option and a put option at the same exact strike price. And then you're going to buy a call option with a higher strike price and then buy a put option with a lower strike price. So this is basically a squished Iron Condor to where your short strike prices are at the same level. And our assumption with the Iron Condor was that the stock would be between our strike prices for the calls and the puts. But with the Iron Butterfly, since we have the same strike price for both our calls and our puts, we want the stock to be immediately at the price that we sell our options for. So we want the stock to end up at the short strike price for both our call options and our put options in order to realize our maximum profit which is just going to be the credit that we receive whenever we open these trades. And the expiration date is going to work just like the Iron Condor. We want 30 to 45 days until our expiration to capitalize on time decay. And the strike price that we choose can really be anywhere, wherever we think that the stock is going to end up on our expiration date. Ideally, you want to choose a strike price as close to the current share price as you can. And the reason for this is because options that are right at the money are going to have the most extrinsic value based on the bell curve. So whenever you're choosing your strike price for the Iron Butterfly, you want to be as close to the current share price as you can, while still taking on the same assumption that the stock will be right at that strike price on your expiration date. Now, the odds of a stock trading exactly flat over the course of 30 to 45 days is incredibly low, but because it's so incredibly low, you're going to get a lot more credit than you would otherwise if you were to widen your strike prices like with the Iron Condor. So with the Iron Butterfly, you're going to get more credit, but it's unlikely that you will realize your maximum profit with the stock exactly at your short strike prices. Again, you could always go with a different strike price that isn't at the current market value, but you are going to end up getting less credit since it is not right at the money. And that's the basics for the Iron Butterfly. I know it's a more complicated strategy, so let's get into our example. Now with the Iron Butterfly, again, we want to choose a stock that we're neutral on. And I think that Tesla, again, is going to be neutral on its earnings report. So I'm going to go with a February 25th expiration, so a little bit more than 30 days out at this point. And I'm going to assume that Tesla is probably going to be around $900 on our expiration date. So I'm going to start out by selling a put option at the $900 strike price. I'm going to sell a call option at the same $900 strike price. Then I'm going to buy a call option with a higher strike price, so we'll go with the $910 call, and then buy back a put option with a lower strike price, so we'll go with the $890 put. All in all, we're going to get paid $972 a credit in order to open this trade, and we need Tesla to be right at $900 on our expiration date on February 25th in order to realize this full amount of credit. Now, the closer that Tesla is to $900 on our expiration date, and the closer we are to our expiration date, the more this credit that we're going to receive. If, say, Tesla goes up after the earnings report by, say, 10% to $1,000, then this option is going to lose a lot of its value. But the good thing is that we don't have a lot of money to lose. Our maximum loss for this trade right now is $20, or the $1,000 of collateral we're putting down for this trade minus the $980 of credit. But the problem is we need Tesla to be exactly at $900 on our expiration date. And what are the odds that Tesla is going to trade exactly flat over the next month? I'd say it's pretty dang low. But because of the high unlikelihood of this happening, we get a lot of credit and we're taking on a lot less risk accordingly. But don't get it twisted, because there are pretty big risks associated with the Iron Butterfly. So let's talk about those. Now, the risks for the Iron Butterfly are just like with the Iron Condor and credit spreads, to where you don't want the stock to end up between your strike prices on your expiration date for the calls and the puts. So if the stock ends up between your call strike prices, then you're going to have to sell 100 shares of your stock at your short call strike price. And if the stock ends up between your put strike prices, you're going to have to buy 100 shares at your short put strike price. So we don't have enough money to buy or sell 100 shares of our stock, so we don't want this to happen. But the problem is we want the stock to be right at the strike price that we chose to sell our options at. So this is kind of a double-edged sword, to where we have to have the stock exactly at a strike price, and if it's off just by a marginal amount, then we're going to end up getting assigned. So obviously we want to avoid this, and the way that we're going to do this is by closing the options before the expiration date. Again, you can close them any day before the expiration, whether you're at a profit, whether you're at a loss, it doesn't matter. You can close them on the same day of expiration. And with the Iron Butterfly, I would absolutely suggest closing this if you think the stock could be between your strike prices. Hopefully by this point, enough time value has been evaporated, and if the stock is right at your short strike prices, you should capture a lot of the profit to be made. Although it won't be maximum profit, you should make a substantial amount of profit from this trade. And that's pretty much all the details that you'll need for the Iron Butterfly. I know it's a more advanced strategy, so if you have to watch that clip a couple times through, go ahead and use the chapters feature down below. That's all the income strategies I've got for you today. Thanks for making it all the way to the end of this video, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.